Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial Insurance Services, and we're back with you today for our weekly wrap-up. Graham, can you please tell us what's been going on in the market this past week?
Yeah, thank you, Stacy, and thanks for our listeners being on the call. A bit more volatility last week, right? So we had some U.S. data come out, continue to point to maybe a softer landing in the economy. Great, right? But at the same time, we had Fitch, a rating service, come out and downgrade maybe the odds of a default years out. Now they moved from a AAA rating down to a AA plus, and we'll get into that a little more details in a minute. So that puts obviously some stress on the equity market as well as the bond market. So we saw the NASDAQ off about 2.85%. The S&P fell about 2.25%. And the NASDAQ, the Russell was off about 1.2%. So we saw 10 of the 11 S&P sectors really losing ground. For earnings, kind of putting the pressure on the market. We had some big players out there because we're on the latter part of earnings season here, the downhill slope, if you might. Apple came out with good earnings, but saw some pressure on handsets. It was off about 5%. Another big player in that area, Qualcomm, off about 6%. Similar issues. So what was the issue last week? What sector? It was technology, off about 3.8%. Energy sector was kind of the stalwart last week. It was up about 1.25% as we saw Saudi Arabia extend its production cuts by 1 month, which helped kind of buoy or lift that crude market. Going back to the Fitch downgrade, we saw them move from a AAA rating down to a AA plus. Now, they expected some fiscal deterioration over the next 3 years. Couple areas that they highlighted: erosion in the financial governance, repeat debt ceiling standoffs, and which caused of the inversion of the 2 and 10 year brought them a little bit closer. But if we kind of narrow down on the U.S. economy, we did see job growth in July fell below expectations, but we did see the average hourly earnings tick up a little bit. Again, we want to kind of see that moderate down, taking some of that pressure off, some of that inflation off the economy. Labor production did jump a good bit to 3.7%. At the same time, we saw factory orders increase 2.3. So the manufacturing PMI still showed contraction. Overall, the data suggested that when the Fed gets back together in September, they're likely maybe another rate hike, but keeping rates higher for longer. And I think that was what came out of this. Internationally, we saw the Bank of England raise rates 25 basis points to 5.25. Now, that was a slower pace. They've been increasing at about 50 basis points. Inflation data forecast did ease a bit. Australia, central bank decided not to raise rates, so they held off. And the euro annual inflation is expected to dip to about 5.3 from 5.5. So we're seeing some less pressure on rising rates, at least in inflation over in Europe. Kind of blamed a bit on maybe some higher food prices, still remained a concern over there. We did see the Eurozone gross domestic product, or the GDP, slow to about 0.3% expansion in Q2. Really slow growth. And really China, we saw the China factory activity slow again in contraction area for July for both the government and the private sector.
Okay. Well, Graham, are there any months out of the year that are better for the equity markets than others?
Yeah, if we go back to 1981, you might say about August, September, and part of October can be some of the weaker months. But of the 39 summers, we had about 15% of them, or 15 of them down. That's about, just over 38%. So you can see after earnings season, we get into the summer doldrums, a bit of a weaker market as we approach and get into the fall. And then we kind of pick up again as we get late into the year and we start thinking about the new year. And we start thinking about window dressing for the funds and institutions. We get into the things called Santa Claus rally. So we are moving into traditionally, not always a guarantee, some slower times in the market, sometimes some reasonable contraction.
Okay. Well, thank you so much for that. And thank you to our viewers for joining us today. And I just want to throw out there that we do have some space available for our Saturday retirement planning Today class, which is from 9 to noon this coming Saturday and the following Saturday. It's a multi-day class, and you really learn the A to Z on a retirement planning process. So if you can fit that in your schedule, give us a call. We would love to put you in class. So have a great week. Good weekend. We'll see you again next week for the weekly wrap up. Thanks so much.
Take care.